Imagine becoming the richest person on Earth. Your fortune is so vast that governments borrow from you. Newspapers describe your wealth as limitless. Entire industries rise because of your ambition. Every room falls silent when you enter. Now imagine dying almost completely broke. Not because someone stole your fortune, not because of a market crash, but because you slowly convinced yourself that the rules no longer applied to you. It sounds impossible. After all, how does someone who earns billions lose almost everything? The answer isn't found in accounting. It's hidden inside the human mind. Because history has shown something fascinating. Making money requires one set of skills. Keeping it requires an entirely different one. And confusing those two abilities has destroyed more fortunes than recessions ever have. To understand why, we need to meet a man who, for a brief moment, seemed unstoppable. In the early 20th century, Jesse Livermore became a legend on Wall Street. He wasn't born into wealth. He didn't inherit an empire. As a teenager, he studied stock prices so obsessively that he began noticing patterns other people ignored. By the time most young men were still figuring out their careers, Livermore was already making and losing fortunes. He was brilliant, fearless, patient when necessary, aggressive when opportunity appeared. Then came 1929. As most investors believed the stock market could only go higher, Livermore reached a different conclusion. He began betting against the market. Friends thought he had lost his mind. Newspapers celebrated endless prosperity. Ordinary Americans poured their savings into stocks. Optimism had become contagious. Then, everything collapsed. The stock market crash wiped out billions of dollars in wealth. Businesses failed, banks closed, families lost everything. But Jesse Livermore became richer than anyone could imagine. His profits during the crash were estimated at around $100 million. Adjusted for inflation, that's worth well over $1 billion today. He had conquered Wall Street. He had solved the puzzle everyone else failed to understand. Or so it seemed. Because this is where everything changes. Most people believe financial success creates confidence. Sometimes it creates something far more dangerous: overconfidence. Behavioral psychologists have studied what happens after repeated success. When people experience a series of victories, the brain begins searching for explanations. Rarely do we credit luck. Rarely do we acknowledge timing. Instead, we tell ourselves a more satisfying story. I won because I'm exceptional. This belief feels empowering. It can also become incredibly expensive. Researchers call this the overconfidence bias. People consistently overestimate their knowledge, underestimate risks, and exaggerate their ability to predict the future. Ironically, the more successful someone becomes, the more vulnerable they may become to this illusion. Because success doesn't simply increase wealth, it increases certainty, and certainty can be dangerous. Livermore continued trading. Sometimes he made fortunes, other times he lost them. Each recovery reinforced his belief that he could always come back. Each comeback made the next risk feel justified. His greatest strength slowly became his greatest weakness. He trusted his instincts more than his limits. Then something unexpected happened. The markets changed. Strategies that once worked stopped working. Economic conditions evolved. New participants entered the market. The game itself was no longer the same. But human beings have a fascinating tendency. We often mistake past success for permanent ability. Psychologists call this the illusion of control. People naturally believe they influence outcomes more than they actually do. Gamblers feel lucky after winning. Executives believe every successful quarter proves their genius. Investors assume a rising market confirms their intelligence. Sometimes they're simply experiencing favorable conditions. Distinguishing skill from circumstance is one of the hardest challenges in finance. However, the psychology runs even deeper. Neuroscientists have discovered that financial gains activate the brain's reward system in remarkably powerful ways. Winning doesn't merely produce satisfaction, it releases dopamine, the chemical associated with anticipation, motivation, and reward. The surprising part is that dopamine doesn't encourage contentment, it encourages repetition. After a massive victory, the brain doesn't say, "You've won enough." It whispers something far more dangerous: "Do it again." For some people, extraordinary success creates the same psychological pattern found in gambling. The thrill becomes addictive. The stakes gradually increase. Small victories no longer feel exciting. Only bigger risks provide the same emotional reward. This is known as reward adaptation. What once felt extraordinary eventually becomes normal. The brain constantly raises its expectations. History is filled with examples. Business empires built over decades vanished because founders believed expansion could never fail. Professional athletes earned hundreds of millions yet retired bankrupt. Lottery winners spent life-changing fortunes in only a few years. The details change, the psychology rarely does. Success often convinces people that the future will resemble the past. Economists call this extrapolation. We naturally project recent experiences forward. If investments have risen for years, we assume they'll continue rising. If business has always been strong, we assume demand will never fade. If we've solved difficult problems before, we believe we'll solve every future problem too. Reality is rarely so generous. Jesse Livermore's financial life became increasingly unstable. Despite rebuilding his fortune multiple times, he also experienced devastating losses. By the end of his life, much of his immense wealth had disappeared. His story ended not with triumph, but with tragedy. His financial rise remains legendary. His personal ending serves as a sobering reminder that extraordinary intelligence does not guarantee emotional resilience. But here's what nobody tells you. Livermore's story isn't really about Wall Street, it's about human nature. Because every one of us carries the same psychological software. The scale is different, the mechanisms are identical. A successful entrepreneur begins believing every new business idea will succeed. An employee receives several promotions and assumes career growth will continue forever. A homeowner watches property prices rise for years and concludes real estate never falls. Confidence quietly transforms into certainty. Certainty gradually replaces curiosity. And curiosity is often what protected us in the first place. The greatest investors in history seem to understand this paradox remarkably well. Warren Buffett has often emphasized the importance of avoiding catastrophic mistakes over chasing extraordinary gains. Charlie Munger repeatedly warned against believing your own success stories. Ray Dalio speaks openly about embracing humility because markets constantly expose overconfidence. Different people, different generations, the same lesson. Staying wealthy requires respecting uncertainty. Perhaps this explains why preserving wealth is psychologically harder than creating it. Building wealth rewards ambition. Keeping wealth rewards restraint. Building wealth often requires bold action. Keeping wealth often requires knowing when not to act. Those are completely different emotional skills. Society celebrates the first. It rarely notices the second. Perhaps that's because restraint isn't dramatic. No headlines announce the investment you wisely avoided. No magazine features the fortune you protected by saying no. The greatest financial decisions often look like nothing happened at all. And yet those invisible decisions quietly shape entire lifetimes. The richest man who died broke isn't just one historical figure. He's a pattern. A reminder that success without self-awareness eventually becomes fragile. Because money amplifies character more than it changes it. If impatience exists before wealth, wealth often magnifies it. If ego exists before success, success often feeds it. If humility exists, wealth can strengthen that too. In the end, fortunes are rarely destroyed in a single dramatic moment. They erode through thousands of small decisions shaped by confidence, emotion, and the comforting illusion that yesterday's victories guarantee tomorrow's. Perhaps real wealth was never measured by how much someone could earn. Perhaps it's measured by how much wisdom survives after success arrives. Because the greatest financial risk isn't running out of money. It's believing you've become too successful to lose it.